Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. China's trade numbers have created quite the stir, especially when we look at the major Asian pairs. Majorly, all Asian pairs have weakened against the USD. This has continued to put a pressure on rupee, which is testing the key psychological level of 83. Now, China's inflation numbers are out with July CPI coming in negative 0.3% and negative 4.4% when it comes to PPI. Not just that, the PBOC has continuously tried to set the yuan fixing stronger, today setting at 7.1588 against market expectation of 7.2198. Clearly, they don't seem to be very happy with the depreciation in Chinese yuan. Morning, JK. More pressure expected on Asian FX after the inflation figure. What's your take on this?
Good morning. I think China data today was kind of expected, and that's why there is no much reaction immediately after the number. But it is notable that the economy is in a disinflationary situation, and add to that lot of negative data that we have been getting of late, particularly the export and import numbers, which fell significantly in July, published yesterday, creating quite a stir in the markets. And China demand coming down is an impactful factor for most other economies, and particularly the commodity exporting countries like Australia, Canada, and New Zealand. Their related currencies were actually also hit along with other Asian currencies. Of course, yesterday was some sort of a comeback for rating agencies. Like, in fact, that has been seen recently. Fitch was one who created a turbulence in the market by downgrading US late last month, and then Moody's yesterday by downgrading 10 US banks has actually again hogged the limelight, by creating volatility in the market. And they have in fact put many bigger banks also on the watch. So 6 big banks, in fact, and that actually gave rise to risk-off sentiment. And it was added to by the Italian government, which imposed a 40% windfall profit tax on the excess profit made by banks on higher interests. Then, the Chinese trade numbers came that added to the volatility. And in fact, we also had other data from China which showed that vehicle sales had been falling, and it was about 50% lower than what it was in the previous year. So all these together, we did have a big fall in the equities, and that carried into the European and the US markets. Side by side, we also had a fall in the yields because people were shifting from stocks to safety of the yields. And yields at these elevated levels have really also seen value buying from markets. So, but there was a kind of turnaround in the US markets. One factor was the banking index did not fall as much as one would have thought, and it was much better off than what we had seen in May in the wake of banking crisis. That was one factor. The other was a clarification from the Italian government that the windfall tax would be restricted to 0.1% of their assets. So that gave some relief to the stock markets, and we did see a comeback from the stocks in the S&P 500 as well as in the Dow, which was at one point of time down by more than 400 points, and then it ended less than 200 points negative. Also, on the yields, there has been a good response to the recent issuances by the Treasury, and that has also seen the yields come off. In fact, the 30-year came down by about 5 basis points, and the 10-year came down by about 6 basis points. Of course, the 2-year yield has not been going up because of the increasing belief from market participants that the Fed rate, Fed rate peak is almost in. And we also had some sort of a soothing statement from one of the Fed members, which Mr. Harker, who said that the state of the economy was, made him believe that we may be at a point where we can be patient and hold rates steady, although he does not see any circumstance that would warrant an immediate easing of the policy rate. Anyway, market has not been expecting a rate cut until the March of 2024. We also had some data from US, which the small business sentiment as measured by the NFIB Institute also nudged up for the third consecutive month, and the trade balance or the trade deficit of US also narrowed much lower to 65.5 billion from around 68 billion that was expected earlier. And significantly, the goods import by US from China has fallen by about 25% compared to a year back, and their imports from Mexico and Canada have increased. So that's significant point, and also is reflected in the Chinese trade data as well. On the currencies, yeah, along with the risk-off sentiment, we did have a broad rally in the dollar. But the moves in the major currencies like Euro and GBP were all well contained within the recent ranges, and no new level was broken, while the dollar yen was almost stagnant near 143, 143.20. Bigger move was seen in the emerging market currencies, which were all down more than 1%. Of course, China led the way because we broke 7.20 well before these events, and then we went as high as 7.25. Now it has retraced somewhat because we were closer to the previous peak at 7.27, and also market has gotten a bit short on the Chinese yuan against the dollar, but the underlying trend seems to be very much in place for more weakness in the yuan, perhaps awaiting new triggers. The currencies also are on the defensive, or rather I would say somewhat of a rangy side, because we have the US inflation number, which is expected tomorrow. Only the headline number is expected to rise by 0.3%, with all other numbers expected to remain same, but any deviation, particularly in the core inflation to the upside, will create a next bout of volatility. Hopefully markets do not see bigger volatility like because yesterday's events coupled with any higher inflation can see more sell-off in the assets as well. On the rupee, we have tested the big resistance at 80 to 85 in the onshore trades, and in the offshore trade we had almost crossed 80 to 95, but then it has made a comeback with recovery in stocks and also in the emerging market currencies. More importantly, the rupee, while we have seen sharp retreat after tests of such levels in the past, that may not happen very soon now, because we have several headwinds like RBI meeting tomorrow. I don't know, even if a minority expectation of a rate hike as a response to the big rise in inflation that is expected due to food prices as well as the oil prices. But of course, majority are favoring status quo. Then we also see how they forecast the inflation going forward. Can be an upward revision there, and then growth, which is likely to be maintained at the previous forecasts. US inflation, of course, that's another factor for which the rupee traders will give respect and will not try to move it either way in a big fashion. And then finally, the inflation number on Monday, which will be in the region of about 6 to 6.5%, as most forecasts are indicating. That's a big jump from 4.8% that we have seen last month. The response of the central bank in this regard will probably be known only in the next meeting, but there will be some nervousness ahead of these figures, particularly in the stock market. Overall, I think rupee should stay in the higher range for some time more, and even as Chinese yuan trades about 6.2122, it's unlikely to see a bigger retracement in the rupee until we get to all these big events. Thank you.
Thank you, JK. And the major data point coming in yesterday was the Chinese economy, which is in disinflationary situation. Yesterday, we saw the export and import numbers both fall significantly, and now we had the PPI and the CPI data also coming in negative. This has hit the commodity exporting countries like Australia, Canada, New Zealand. Their currencies were also weaker because of these Chinese numbers. Italy has put a windfall tax on profit of banks due to the rise in interest rates, which banks have taken advantage of, but not passed on to the depositors. So that was a major news that was that we were following yesterday, and we are seeing some good response on the recent issuances by the US Treasury. Some cool off in yields is being observed over there. INR tested a key resistance of 80 to 85 on the onshore market. Now, several events like RBI meeting, CPI, US CPI data can prove to be a bit of headwinds for rupee to appreciate quickly. That's from us today. Thanks for listening. Tune in tomorrow for another round of fresh updates. Thank you.